Hi, I'm Professor Zubair Jahangir. I'm a company secretary and advocate, and this is the CRVI Marathon. In this marathon, I will be covering the part 2 of your syllabus. So, part 1 is your corporate restructuring, which is your entire 40 marks. Your part B is your valuation, and it's a bonus marks for you because two chapters come and cover a guaranteed 20 marks from your syllabus. I will be covering both these chapters in complete detail and from the ICSI study material. So if you have the ICSI study material, that is great. I have tweaked and made the notes a little better, and from which I will be teaching. So do share this video with your friends and hit the like button as well. And remember, we have a WhatsApp group, link is in the description. You can go ahead and join for more such marathons and revision lectures. So wish you all the very best. Let's begin with the marathon. Hi, so we'll be starting with your lesson overview of business valuations. Now remember that your overview of business valuation and lesson 13, that is your valuation of business, comes mandatory for 20 marks in your examination. So we will put our entire efforts and do it completely well. Let's begin. Overview of business valuation. Now first thing is, when one company plans to buy another company, so whenever you go to buy something, you have to fix the price. You need to find the value of it, and accordingly the money will exchange hands, and accordingly we will pay the price. So once we fix the value, then we will pay the price. Now how is value fixed? Who fixed the value? What are the valuation principles is what we will be studying in this chapter, the valuation methods, etc. A basic real life example is when Zomato acquired Blinkit for 4,447 crores. Okay. Now, when Zomato acquired Blinkit, they paid this random figure. Now, obviously, this random figure was the value of the company. Now, how was that computed? What are the aspects of it is what we will understand. Let's start. So, first thing when we start is the introduction. That the meaning of the term valuation. Now remember that when something is pretty simple, I don't expect it in an exam, I will go faster. You can go faster with me. Okay. When something is important, I will stop and mark it as important. Now very first thing is, you have to remember that it is given under which chapter valuation? Chapter 17. Okay, of Companies Act, read with your section 247. 247 read with the valuation rules 2017. Clear? So we will be seeing now, what do you mean by the term valuation? So valuation is a process of fixing the worth of a particular asset. So it is fixing the worth of an asset. Now obviously it is context specific. That means valuation, the value of a person, the value of something will change from person to person. If it is a related business, maybe I might value it more, but an unrelated business might not care for it at all. Okay. Now the valuation of businesses is done by a valuer, and a valuer is, all the details of them, is a registered valuer. It is given under section 247. So sir, what is ultimately the term valuation? So valuation is a process of determining the value of certain assets, and value is always shown in monetary terms. So I will come to know that the value of this company is XYZ, the value of the machinery is so and so. So it is assessing the worth of an asset. Now, while fixing the value, we look at various aspects. So if I am fixing the value, I look at various aspects, factors. This will come later part of the chapter as well. Okay. So whatever it is ultimately a professional judgment. Okay. So two valuers will value two companies differently according to their past experience, according to their professional judgment, according to different methods. Different values can come up. Okay, so valuation is a professional judgment. It is not, nobody can say that this is the exact value. Another person will come, will look at different things, different risks, different strengths, and might value it differently. There are different and multiple valuation approaches and methods. Now, always remember that valuation is expressed in terms of money. It is a financial information. Never can valuation be given not in terms of money. Okay, so it is always given in terms of money so that others would come to know that this is the value of a share, this is the value of an asset, and accordingly, price will change hands. Now, coming to something that is important. So just I'm going through, not everything is important, I'll be telling you. Okay, so first thing is your genesis of valuation. What does the genesis of valuation mean? Just a simple thing. Again, they are repeating that valuation is a process of determining the economic worth of an asset. That what is the worth of this company. Okay, and normally valuations could be done for various purposes. For example, if I'm going to buy a particular company, so I would want to value that target company. Second, if a bank wants to give a loan to a company, they would do an assessment of the valuation of the business and then sanction the loans. If we saw Vodafone, there was a 2 billion tax case. Now again, they determine the value of the company, the value of the shares, accordingly the capital gains, etc. can be determined. Valuation in case of property, if a compulsory acquisition of property is done, so again we need to find the worth of that house, accordingly compensation will be given. Valuation in case of insurance can be done. So if we want to fix the premium, so if a valuation of a particular fire insurance is done, so they will have to value the assets, the buildings, the whatever it is, that this is the worth, and accordingly the insurance company will fix your premium amount. Okay, now remember this small little part that which I want you to quote in the exam. Okay, I want you to quote in the exam that the Rick's Red Book, okay, is there. What happened is in UK 1970 there was a crash, property crash, just like in USA in 2008 there are the subprime mortgage, subprime crisis, where people could not pay the mortgages, and then the entire Lehman Brothers had become bankrupt. One of their main banks had become bankrupt. So that time the Riggs Red Book and USA, they try to form certain valuation principles because because all these banks ended up giving wrong loans. Anyone used to come, they used to give a loan. So now they said we should have some standard principles, who you're giving a loan and how that valuation should be done. So what is Riggs Red Books? It's a UK. In UK in 1970 there was a property crash, and then the Riggs Red Book said that introduce certain valuation standards. Now this is internationally. Similarly in USA after the 2008 crisis, they also said that we should have some valuation standards. Now coming to the need for valuation. Okay, why is valuation needed? I'm just thinking, why is valuation needed? So how will you pay the money? You will, to determine the price of the product, to know the value of the product, you have to do the valuation. Once you know the value, it will come to know that how much you will pay. You shouldn't overpay or underpay. That is why it helps in your strategic decision making. So when companies are planning, now WhatsApp or Facebook plan to acquire WhatsApp, so they will do a valuation to know whether it is strategically advisable to give or not give. When you saw same thing when Elon Musk went to buy Twitter, he made a miscalculation and ended up paying a very higher amount in for Twitter. So valuation is always done by an independent valuer, by a person who is unrelated. All we will see when we do. Right now, we just have to do the headings of why valuation is done in which situations. So M&A is being done, valuation will be done, merger and amalgamation. If JV, collaboration, if ESOPs are being given, so they have to identify what is the value of the share, how much discount are we giving. Okay, whenever an investor plans to exit, he will have to find out what is the value of the company, and then accordingly he will exit. Okay, if there is operation and mismanagement in the company, then again in that case, to identify whether you are having the thresholds to file a case in NCLT, then it will be done. Then comes under company law. Sometimes statutory laws only tell that they have to do, for example, private placement, or in case of sweat equity, valuation is told by law itself for laws, etc. Okay, winding up, valuation is to be done. Now, coming to factors influencing valuation. Now, this is the first thing which they have also asked in the exam, and even in the next chapter, again they come writing factors of influencing valuation. Now, what does it mean? If I'm looking at a company, what factors affect the valuation? If a company has taken tremendous amount of loan, can I say that their valuation will drop? If a company is giving regular dividend, its valuation will increase. I'll look at I look at their past financial results. I will look at their PE ratio. I will look at their future prospects. So all these factors will be looked. I will look at their data collection methods. I will look at various factors, and this is what we will see. So after doing a due diligence process, after studying a particular company, the next thing is to identifying that we've identified this company. Now we will say, let's buy it out. To buy the company, to purchase the company, we will do a valuation to fix the price. Now, following things affect the market price. Okay, if a company is just supposed to come out with an IPO, so that also can affect the market price. If the company has tremendous amount of special shares, those voting rights, differential voting rights, so then again the value can drop because promoters have extra voting share. So past headings we can do, nothing concrete. We will look at your bonus track record. We will look at news. We will look at the net worth of the company, net assets, liquidity of the company. We will look at the past history of the prices, voting strength. All these factors affect the valuation, the expected rate of return, etc. Ongoing projects, etc. Okay. Now we come to one general stuff which they have told. What are the general principles of valuation? Now, what are the principles of valuation? Very, very theoretical. Just the headings we remember, it is enough. Okay. In almost all business valuations, there are some principles which are. So, if I want to fix the value of my phone, okay, how will I fix the value of my phone? Okay, how will you fix? So obviously you will first look at substitutes, that what if someone wants to buy the same phone with the same features, where will they go? Okay, because an investor will not pay more than that of a substitute available in the market. Similarly, alternatives. Okay, if there are many alternatives, obviously it will affect the valuation of the company. This is also to be understood. Second, I will look at, if I am buying a company, how much of a gain inflows they will give me over a period of time. So if I buy this company, like for example, Google bought over YouTube, then they will look at, listen, how much of YouTube will give me generation of, how much money will it generate. So you will study, and future cash flows can be brought down to present value also. So time value will also be given, will be done. So this is what they are saying. Principles of risk and return. Tell me one thing, would you want to invest in stock market? Cryptocurrency? High rate of return is there. So obviously higher the risk, higher is the probability of return, but you don't want to take that much risk. So accordingly you keep a factor of risk and return. Expectation cash flow. So some of the points are repetitive only, but we can do the headings. And reasonableness. Okay, principle of reasonableness is to look at the nature, historical background, brand image, etc. Just all the reasonable practices and close it. So while doing valuation, I will do time value of money. I will look at the risk return. I will look at the substitute alternatives. Reasonable expectation of cash flows, reasonableness, and alternatives. Just headings and online is enough. Now we come to important part. Now, moment you see Companies Act, any section, that chapter becomes important. First, principles or purpose of valuation. Sir, why valuation is done? Okay, why valuation is done? Purpose of valuation. See, valuation could be done for two reasons. Okay, valuations could be done for two reasons. One is the maybe non-statutory reasons, and the other one could be for statutory reasons. Sir, what does this mean? For example, if law mandates, so many times it is written that when a company is going for delisting, they have to do valuation of the share. So it becomes statutory reasons. If there is sweat equity, valuation might be doing. However, for some cases, if valuation is not prescribed by law that you have to only do a valuation, because someone is giving a loan, they might not do a valuation. So that comes on basis of your personal preferences on the transaction type. You might want to decide whether you want to do a valuation or no. It is optional if not law has not specified. So purpose could be strategic purposes, business purposes, or legal purposes why valuation is done. Let's see. Okay. Now, in India, I told you chapter number 17 of the Companies Act talks about valuation. Okay, that we need to have certain valuers, registered valuers, and in this you go to your section 247, subsection 1, 2, 3, 4, all we will do. Subsection 1 says that it is mandatory to do a valuation from a person who is registered with the institute. Okay, that is subsection 1, not given here. That you have to do from a registered valuer. So subsection 1 says that you have to do from a registered valuer. Subsection 2 says that the valuer shall, now the responsibilities on the valuer, that he should be impartial, he should exercise due diligence, he should follow the rules, and he should not take, now this is the fourth is important point, that the like how auditors, you should not be connected with the company. For valuation, they say 3 years before the transaction and 3 years after the transaction, you should not be connected with the company. So shall not take valuation directly or indirectly 3 years prior to appointment or 3 years after valuation of the assets conducted by him. So this is the first time they are saying that after I have done the valuation, I cannot be connected with the company also. So the valuer has to ensure all of this. Now we come to the rules. Okay. Now let's understand the company's registered valuer and valuations rules 2017. Now they say who is a registered valuer. So registered, so this person must be registered with other RVO, okay, registered valuer organization. What is a RVO? RVO enrolls these registered valuers. I'll come to it, don't worry. Okay, let's see, let's complete it. So first thing is your IBBI, okay, your Insolvency Bankruptcy Board of India. Okay, all insolvency related matters is dealt with IBBI. They register your first RVOs. So what is registered value organization? So what are these? So RVOs are basically CA, CS, CMA institutes. They have all form a Section 8 company and they have got registered as a RVO. What is the job of an RVO is just like how ICSI conducts examination for company secretary. RVOs, registered valuer organizations, all CA, CS, CMA have set up a Section 8 company called as ICAI RVO, ICSI RVO, ICWA RVO. They have formed themselves and then they conduct these examinations. They take action for professional misconduct. They charge fees. Okay, they set up valuation standards, etc. And all these valuation exams are done. So are you clear with what is a RVO? If you clear your examination of CS, you become a company secretary. Similarly, if you clear your exam for RVO, you become a registered valuer. Concept clear, everyone? Simple little thing of what is RVO and this. Now, an individual shall be eligible to be and registered valuer if he is a fit and proper person. He has a proper expertise. He is a valuer is a member of an RVO, has completed the recognized educational qualification, has passed the examination, and is recommended by RVO for registration. Very simple logical sense. That first point, if you would say, which is the most important point out here, that an individual will be allowed to be a registered valuer if he is cleared the exam, if he's failed the exam, or he just filled the exam form. He will not be allowed. So he has to first clear the exam, then have the necessary qualification, because sometimes now you have MSOP, TDOP, all those he has to complete and become a member. Now, valuation standards. I told you in the very start that valuation standards, right from before we come to our valuation rules 2017 of India, before that I have told you something, that in the very beginning for UK, what was the UK? I told you have to remember the RICS. What did they do? RICS published a red book which gave valuation standards and professional conduct to be followed by valuers. So they made standards for valuers. What does this red book do? After the property crash, they made standards for valuers. Similarly, USA also in 1980 also there was a property crash, and in 2008 also there was a property crash. Even they made some universal uniform standards to be followed by valuers. Clear? Let's come to something important. Okay. Now we saw for your particular UK, USA we saw. Most important is, sir, what about India? So this I want you to quote in the exam. That is your chapter 17, read with section section 247. Sir, what does it talk about? Valuation provisions under Companies Act. So this has been given. Valuation in respect of a property shall be done by a person who is registered as a valuer only. Now let's do the subsections. Okay, so now this is actually your subsections. So this is your section 247. This is subsection 1, this is subsection 2, so on. Subsection 2 we have already done before, yes or no? Sir, what I told you now above, that the person should be impartial, should exercise due diligence, should make a valuation, and should not be connected 3 years prior or 3 years after doing the valuation, right? And so this is subsection 2 we had already done above. Flip and see, same provision has been given. This is subsection 1 which I told you to write, that where a valuation is required under law, statutory valuation, then it has to be done by a person having qualification and registered as a valuer of a RVO, registered valuer organization. Then third talks about penal provision, that if the valuer contravenes anything, he will have a penalty and what all he will be liable. So if a valuer got penalty, then he can be liable to refund all the remuneration he has got and also pay for damages. So subsection, at least in the exam we can quote section 247, which is coming under chapter 17, and we can write the section numbers also. Subsection 1, 2, 3, 4. 4 says that what all he is liable to pay. So he has to refund his money that he has taken, and he has to pay damages. Penal provisions are given here. 2 is about what all duties that he have, and 1 is about only a registered valuer can do a valuation. Concept clear? This I want you to quote in your examination. Clear? Let's see next. The registered valuer rules 2017. Sir, you did section, now we are going to do rules also. Answer is yes. What is the big deal? It's going to be pretty simple. We will be doing rule 3, rule 4, rule 5, everything will come. Okay, So in the examination, you should be loaded with sections, subsections, and the rules. So first, before we start for the valuation rules, we should at least know the rules are of which year, because this we have to quote in the exam. So companies registered valuers and valuation rules 2017. The central government, via its notification, has notified these rules. So good portion has increased for us. Okay. The notification brings in clarity with respect to valuation. Common sense, it will bring in clarity. Okay, and it will standardize the prevalent diverse practices. So it will standardize, make all the multiple various methods of doing the valuation, they will make it uniform. They will improve and change the entire transparency. They will improve the governance. They will ensure that everything is more true, more correct, fair, complete, etc. Sir, okay, theory is done. Now let's start with the rule numbers. Now the rule numbers are important. Okay, just write down and close it. First is rule number 3, eligibility for registered valuers. Let's take for example, I have my younger brother. Okay, I have my younger brother. He is 2 years old. 2 years old. Allowed or not allowed? Quickly. Can he become a registered valuer? 2 years old. Answer is no, he should not be a minor. Okay. Let's say my elder sister. Can she be a valuer? Answer is no. Again, why? Because person of unsound mind is not allowed. Okay, just joking. Okay. Next is he should be a member of a RVO. First very simple rule is there. He should be recommended. Now obviously you should be a member and recommended by the RVO. So normally if you want to appoint a registered valuer, you write to the RVO that please recommend a valuer for my business, and they will do it. Okay. And then a person who has not cleared the examination cannot become a valuer. Common sense, they have to clear the examination and have to apply within 3 years of clearing the exam for registration. Means if a person has cleared the examination today, they have to apply for registration within 3 years to become a registered valuer. Should have the necessary qualification, should be a person resident of India, and your entire friend who always keeps borrowing money from you, he can also not become. Why? Because a person who is bankrupt cannot be allowed to be a valuer. Okay. And coming next, if a person who has been, now this is very similar to director disqualification, that if you have been convicted for a term exceeding 6 months, let's say if a valuer has been convicted for at least 6 months imprisonment, then for 5 years he cannot take up the job as a valuer. And if he is after 5 years he can, but if he has been imprisonment for an offense of 7 years or more, then he will never be able to become registered as a registered valuer. Okay. And no penalty has been levied against him. So these are is a fit and proper person. Very simple. So fit and proper person has not no income tax penalty has been put on him, not been convicted. Okay. Person resident of India, undischarged, insolvent. I told you, my friend, my sister, my younger brother, all examples I have given you. And the most important is rule number 3 is you should be a member and registered with the recommended by the RVO and clear your examination. I think the top 3 cracks it. Okay, this is exactly what is there. Now coming to a firm. Normally what happens? You think that all these valuers are one person, or normally they all come together and become a firm of valuers? So obviously they set up a firm. So even a firm is eligible to be registered as a registered valuer. So no partnership or company shall be eligible to a registered valuer if, so normally they can, but they will not be allowed if they have set up for any other objects. So if a firm is there, it's set up for marketing purpose, they cannot become registered valuers. If it is undergoing insolvency, okay, if all the partners or the directors are not eligible. So what does it say? That all the partners should be eligible. If all the partners are not eligible, then they cannot be a valuer only. Sir, why like that all the partners should be eligible? So the logic is pretty simple. What happens is, if valuation is not done properly or there is some fraud, then all the partners can be held liable. So obviously we want all competent partners only. Okay, so all the partners and directors should be eligible. If they are not eligible, none of them, the firm cannot be registered. Okay, 3 or all the partners, whichever is lower. So again, 3 or all the partners. Now understand what does it mean. At least 3 of the partners should be registered valuers, or all, whichever is lower. So imagine a firm having only 2 partners. A firm has only 2 partners. So 3 or all. So a firm has only 2 partners. So all of them is 2. So whichever is lower. So normally they're saying minimum 3. But if a firm has only 2 partners, then all of them should be registered valuer for the firm to be registered as a valuer. Okay. And none of its partners is a registered and none of its partners, so basically one of its partners should be registered for the asset class for which valuation is sought. Means, let's say if I am becoming a valuer for, there are these specific asset classes. Tell me different asset classes. There is gold, there is jewelry, there is land, there is property, there is shares. So even specific, there once you clear your examination, then there are a specific kind of asset classes. One of the partner at least has to be a expert in that subdomain also. Now we come to qualification and experience under Rule 4. What does it talk about? Similarly, that you need to clear the examinations, etc. Okay, so you should be a member of a professional institute. This is where CS will come in, and at least 3 years of experience after such membership. So what is he saying? That an individual shall be eligible for registration under Rule 3 if he has a postgraduate degree. So again, if you are a CS, you have to clear the exam. So first you have to be a CS now and have some practice, years of practice also. So if you are a membership of a professional institute like ICSI, ICAI, ICWA, then you should have at least 3 years of post membership qualification. If you don't have that, but you have a bachelor's degree only, then you have to have 5 years of experience. And if you are postgraduate, then they are saying 3 years of experience. So remember, for postgraduate and CS, only 3 years of post qualification experience is needed. Sir, remember we had done that CA, CS, CMA or CS is considered as a postgraduate only. That is why for them both 3 years of experience is needed. Then you can apply after clearing the examination. Clear? Then we come that valuation, examination and certificate. So on clearing, you will get a certificate of registration. Okay, once who passes the examination. Now we come to conduct of valuation. Means conduct of valuation means what? How will you do the valuation? You will comply with the valuation standards. You will fully disclose all the inputs that you have got. So again, you will do it as per international standards. You will do it as per valuation standards. If you have taken opinion of another valuer, you've taken help of another valuer, that fact also has to be disclosed. And in the end, you will make something called as a valuation report, like how you have your audit report. Valuation report will conduct the valuation, the background information about the company, why did the valuation was done, which method of valuation was used, when he was appointed, as on which date the value is there, and all those things. Now, shall function as given under the Act. Now, eligibility of RVO to be registered. Now, who are RVOs? I told you. So, RVOs are any organization that is a Section 8 company. So, they have to be a Section 8 company and registered with the IVBI. So, professional institute they have to form, and they can be formed as a society, Section 8 or a trust. So, either you form as a Section 8, you form as a society or a trust. So, all CA, CS, CMA have formed a Section 8 company and then they have got registered. Okay. And what is the job of this? Same what ICSI does. They will do for valuers. Conduct examination, grant membership, conduct training, monitor the review, the grievances will be heard, etc. Now with this we finish the first part of the chapter, where we understood about valuation, the meaning of valuation, factors affecting valuation. Then we saw under before coming to Companies Act, in UK Red Book and the US property crash in 2008 and 1980 they have mentioned. Then they came to Companies Act, chapter 17, section 247, 1, 2, 3, 4. Then they spoke about valuation rules 2017, and then they saw rule number 3, 4, 5, 6, all those in order. So that is all that you have to remember. Overview and just able to build your answer is enough. Now we start with the second part. Sir, what is your second part? Let's see. So second part is basically about SEBI. Sir, why SEBI and why ICDR has come here? See, remember, now talking about valuation of shares, pay attention. When I say that there are different asset classes, one of the asset class, value of shares, valuation of shares. Now imagine if you're doing it for a listed company, then obviously who will be the regulator? SEBI. And which law is applicable? SEBI ICDR regulations, right? 2018 will be applicable. So sir, what will be given in this? So obviously how much is the face value that you can keep, what is the price that you can keep, what is the price band you can keep, okay, by when I have to issue these prices, will be the valuation in case of preferential allotment, what will be the valuation in case of your sweat equity, what will be the valuation in case of delisting, what will be the valuation in case when a company is planning to do a takeover. So different scenarios have been captured and they have put up here, okay, and then we will see that what they have given. Clear? So valuation has been said that the value should not be less than any of the following, and then you have to study. So this you have to make your notes, note it down with me and you will be sorted. Okay, now first one is about valuation of face value. Sir, face value. So company is allowed to freely keep whatever face value they want, and this face value has to be disclosed in the documents. So regulation number 27 of SEBI ICDR 2018 says that a disclosure of the face value has to be given, okay, and a face value of the equity shares shall be made in draft offer document, in the offer document, in the advertisement and the applications. Whenever they are giving a price band, every place disclose face value. So what is rule number 27 says about disclose face value everywhere. Now we come to your pricing, which is given under regulation number 28. Sir, what is regulation number 28? So they are saying that the price of a share, now face value is done, now what about the price of share? So your price of share, and if it is a debenture, then what will be the coupon of the debenture. So what is the rule with respect to that? So they say that you are free to determine the pricing of the share. It's your wish. You can determine how much you want in consultation with the lead manager. The lead manager is your merchant banker. This could be, if it is a fixed price issue, you can do it however you want, or if it is a book building issue. Okay, in book building issue you have a red herring prospectus issue where a price is not given. Here the fixed price will be given, your price band will be given. So they said do whatever you want to do, big deal, do it in consultation with the merchant banker. So the issuer company may determine the price of the equity share or the price of the convertible issue, convertible debentures, etc., whatever they want, or even the coupon price for debentures. They can fix, or the conversion price, they can do whatever they want in consultation with the lead manager. If the issuer doing through book building process, then they will also follow the process given under schedule 13. Okay. Now coming to the next one is price and price band. Sir, we did regulation number 27 face value. Then we did regulation number 28, which was the price of the shares. And now we're doing if details more about if there is a price band, by when it should be disclosed, what will be, how big the band can be, how small the band can be. So my first question is, does the company have to disclose in the offer document the price and the price band? Obviously, the issuer may. So now just remember this, that one is it could be a fixed price issue, or it could be a book building issue. In book building issue, red herring prospectus is issued, and in a fixed price issue, directly prospectus is issued. So what it is, normally if the company knows at what price they want to do, they will issue a fixed price, they will issue a prospectus and close it, that this is the price is 200. But if the company is not sure, or they want to fix the price on basis of market demand, then they will issue a red herring prospectus which will contain a price band. Bid from year to year on basis of bidding and request and demand, I will fix my final price. So the issuer may fix the price or the price band. So you can fix the price here and price band here. Okay. And determine a price at a later date before filing the prospectus with the registrar of companies. So if you want, you can determine the price at a later date, which is in case of red herring prospectus, and then once you have determined, then file the final prospectus here. So in book building issue, red herring prospectus, here you will file a prospectus later. That's what they have written. So very simple, very easy. So basically they are saying that you do a book fixed price issue or you do a book building issue. Fine. If you're doing book building issue, give the prospectus later. So very simple. Let's go next. But always remember, prospectus will always contain one price only. Red herring prospectus can contain price band, but the final prospectus will contain only one price. Done. Sir, what is the gap, the maximum gap of price band, the range? So it is 120%. So it can never be more than 20% of the face value. Means if I want to price my security as 100, this is my upper band and lower band, or you could say floor price, and this will be the floor and cap, or upper band, upper price, cap, floor and cap. So cap can be how much? Max. What is the max cap that can be there? Think and tell me. So they have told very simple that the gap between the floor price and the upper cap should not be more than max 120% of floor price. So take 100, do plus 120%, you will come to know the max it can be is 120. Okay. So simply what they are doing is 20% more you can do of the floor price. So the cap band shall be less than or equal to 120% of the floor price. Simple. The cap of the price shall be at least 105% of the floor. So this is the maximum. So max. So price band. Maximum can be how much? 120% of floor price. And minimum. So if I have the floor price of 100 and I keep the upper band as 101, so they will say, for such a small amount, what bidding you are taking? Minimum it should be 5%. Clear? So 105% of floor price. So minimum this much difference and maximum difference is given. Okay. Here, the second point is about that. Price on the price band and the coupon road shall be max 120% and minimum 105% of floor price. So beautifully explained, understood. Let's go ahead. Okay, the floor price of the final price shall be less than the obviously the floor price shall not be less than the face value. Common sense, na? Can I go below the face value? Answer is no, you cannot, and as it is, you are not allowed to issue shares at discount anymore. The issuer shall opt not to make the disclosure of the floor price, of the price band, etc. Means sometimes what happens, you don't want to disclose all the floor price. You want to know by when I can disclose the floor price or the band. So then they will say you can do it at least 2 working days before the issue opening date. So the issuer shall announce the floor price or the price band at least 2 working days before the issue opening date. So I can issue a red herring prospectus. It will not contain the price band also. But before 2 working days, I have to communicate what is a price band. Okay. Otherwise, how people will bid, where they will bid. So before opening of the issue, you have to tell. All the relevant financial ratios should be mentioned. Okay. And also disclose all the relevant financial ratios will also be disclosed on the company's website. Okay. With this, we have completed your this part. We've completed your regulation number 29. Now we'll go to regulation number 30. Sir, what is 30 talking about? Differential pricing. Sir, what is differential pricing? If my employees come, I'll give them a discount. If my existing shareholders come, I'll give them a discount. So my wish. So they are saying that you can keep different prices for different people allowed. But can I give a discount of 60%, 70% or maximum discount level is given? So the issuer may price securities at different prices. Different prices can be given. Now we can give it to retail individuals for all these retail individuals who are there, different price for them. My existing shareholders, I can give them at a different price. Or to my employees, I can offer at a discount, less price. So first point is you can issue a discount to RII, retail individual investors, your shareholders, existing shareholders, and your current employees. So discount or whatever can be given, differential pricing can be given, but max discount that you can allow is 10% at a price not lower than 10%. So you cannot give at a price, you cannot give a discount greater than 10% is what they are saying. In case of book building issue, now tell me one thing, for book building issue, now this is simple. The price offered to anchor investors shall not be lower than the price offered to other applicants. Anchor investors are those investors, they are bringing 10 crores or more in your business. They are, QIBs. They have a lot of money. They are like Ambani, etc. coming in. So they don't need discount. Okay. So they are saying that anchor investors shall not be offered at securities at a price lower than what is given to all the other people. Simple. Anchor investors don't get discount. Ambani doesn't need a discount. For alternative book building method, they have given a separate alternative book building method. They have to comply with that schedule which they have given. And discount, if any, shall be expressed in rupee terms. So if any discount is being given, then that has to be given in rupee terms. So very simple. Regulation number 30 has been beautifully completed. So beautifully I am teaching her. Yes or no? Am I only my fan or even you are liking my teaching? Again, what is differential pricing? Sir, prices can be given at different prices to different people. However, not more than 10%. Big shots don't need discount. Alternative book building method will follow schedule 13, and discount, if they are giving, they have to express in rupee terms. So if I am giving discount to employees, I will say them that how much discount am I giving? 20 rupees discount. That has to be shown in the offer document. Till now, is everything clear? Yes or no? Then we begin with another thing about some trading days, etc. that will come. Okay. Clear till here? Yes or no? Okay. Great. Now we start with the second massive thing which has come in the past exam question also. Let's see. Okay. What it is? Pricing of frequently traded shares if it is listed for at least 90 days. So they've given you regulation 164 and pricing if you are not listed for the second part. Yeah, and here the second part here is the pricing of equity shares if you are listed for less than 90 days as on the relevant date. Sir, what it is, I'm not understanding only. So again, pay attention. What are we doing? We are fixing, what are we doing? We are fixing price of equity shares. Till here it is clear with everyone. We are fixing the price of equity shares. Okay. For a company, if the equity share has been listed, so for a listed company, so we can say it is somewhere like a fixing of this regulation 164, right? Regulation 164. Yes. Now pay attention what they're given. They have said that when we have to fix the price, and this is more like a FPO because you're already listed, right? You're already listed, so now you're issuing new shares. So then they have said that if you are listed, so the pricing and the calculation, the valuation differs, but very slightly difference is there. Differs if you are listed for 90 days or more, or if you are listed, this is the second part, if you are listed for less than 90 days. So first part will be when I'm listed for 90 days or more, and second part will be the pricing I have to follow when I'm listed for less than 90 days. So for example, if a company is there, it is listed for 100 years. So which method will be followed? We will follow the first method. And let's say another company which has just got listed and wants to issue shares, then they will follow the second method. Simple. Let's see. Let's begin and close. Okay. If the equity shares has been listed for on a recognized stock exchange for a period of 90 days or more, then the price of equity shares to be allotted pursuant to a preferential issue, okay, this is for preferential issue, shall not be less than higher of the following. So preferential issue shall not be less than higher of the following. So figure out which is the higher of the following, and you cannot issue at a price lower than that. For example, if I figured out that the price here came 120 and here came 180 rupees, so I cannot issue at a price less than higher. So which is higher? 120. So I cannot issue at a price less than 120. Simple. So what are the two thresholds? One is you are listed for 90 days, na? 90 days or more. So then I will take the 90 days average share price, called as volume weighted average price. Volume weighted average price of the share means the average price will be taken, and the last 10 days WAP will also be taken, weighted volume average price. These two also I will take. This is one thing. So you can see point A, point B, right here point C. Point C, write it down. What it says that third, if the articles are provided for a different method, that also has to be taken into consideration. Whichever is the highest. So for example, here when I took the articles, and articles has given a method of calculating preferential issue and it is coming to 150, then I cannot issue at a price lower than 150, higher of these three things. So let's come back to the rule and done. Okay. So the first rule is, if I am listed on the, now this is what we are doing. If you are listed for greater than 90 days, I'm listed for greater than 90 days, then I will look at the 90 days price, I will look at the last 10 days price, and I will look at if the article is giving a method of calculation of the share price. All the three I will see whichever is the highest, which is the highest here. So I cannot issue at a price lower than highest of all these three. Concept clear? Yes or no? 90 days, 10 days articles, volume weighted average price I will take. Now second scenario is if I have listed for less than 90 days. Points are exactly the same. See, if I am listed for less than 90 days, average 90 days stock price I will take, articles price I will take. So here you will write D. So here they have added one more. You will write C, and here you will write D for articles. So Articles is point is same. If the articles is providing for a method, you have to see that also. Last 10 day volume weighted average price also I'll take. Now I cannot take 90 days price. Now 90 I can't put because they're not listed. So they say for how much ever time you're listed, take a price of that. So average volume weighted average price you will take for the price during you have been listed. So how many ever days you're listed, take a VAP volume weighted average price of that much time period. So they say okay, for whatever time it is there I will take. And then if they are saying one more point, they are adding that if you have done a M&A recently, M&A mergers and amalgamation scheme you have launched under 230 to 240 and you have figured out price there. So 4 things I will see, highest of this I will take, and I cannot issue at a price lower than what is coming in the highest of all these 4. So if I look graphically, it will look something like this. If I am listed for less than 90 days, then I will look the price computed under M&A, if any. I will look at the 10 days past period. I will look at the AOA method, if it has given any method for calculation. I will look for the period that is listed. I will look at that. And one important thing here is connected here. Now pay attention. One small little point will come here. That this. Now this you have taken the average price during the period you have been listed, for the time period you were listed, right? You took a average price, average volume, your volume weighted average price you took for the time period you were listed. Now you have to do recomputation. Now pay attention to this other thing, okay? That under sub-regulation 2, so in the sub-regulation 2, where you were listed for less than 90 days, moment 90 days gets over, you have to do a recomputation and then compare. And if it turns out that it was higher, let's see here. So here we had seen 90 days. What was the 4 points? M&A, 10 days, AOA, and how much ever period you were listed. We came to know this is the highest price. So you can not issue at a price lower than 240. Now they are saying that 90 days when it gets over, when 90 days gets over, you have to do a recomputation. After 90 days gets over, so the thing is not over. After 90 days, again you will do a recomputation, and he came to know that it is at 260. Then you will say that listen, we had issued at 240. Now the difference you have to pay. So whenever company is issuing preferential issue and it is less than 90 days, they will tell the investor that listen, we will do a recomputation. Any difference you will have to pay. Clear? So recomputation will be done after 90 days. Okay. Recomputation will be done after 90 days, and if the recomputed price is higher than above all them, then the difference will have to be paid by the allottees to the issuer. Simple. So we did when we were doing all this to all this was about preferential issue. So all this you can write it here is about preferential issue. So 90 days, 10 days articles. In the other ones is whatever period is there, 10 days articles and AOA, and recomputation you will write. Now they are saying that if above one you are giving it to non-QIB, above you are doing it to non-QIB. Now if you are giving a preferential issue to QIB, very simple point, they have said only one rule, remember, close it. So they, if in the exam they will say that if you have done a preferential issue to QIB, the above one was to non-QIB. If it is for QIB not exceeding 5 in number, then you will issue it at a price not less than 10 volume weighted average price, and articles point also you will do. If articles provide, so 1 point you will do and 2 points for QIB preferential allotment. Then they have said that no allotment, very simple, no allotment shall be made to any QIB who is related to the promoter. So obviously we cannot issue a promoter cannot issue it to a QIB if they are related. Now it is deemed to be related if the QIB has a veto rights, if we have entered into some shareholders agreement priorly, or they have a right to appoint nominee directors. So what are they saying? That a company cannot issue preferential allotment to QIB if they are related to the promoters. Example that if the following things are done, you are deemed to be related, and that is why you will not be issued to promoter. Now we are done with this, the first part. Okay, clear till here? Is everything clear? Yes or no? Okay, so 5 marks they ask here and there, they always ask from all these things. Okay, great. Now let's begin with the other part. Now, Security Exchange Board of India, Share-Based Employee Benefits Regulations 2011. Now pay attention to this. Tell me one thing, this is for listed company or unlisted company? SEBI Share-Based Employee Benefits Sweat Equity Regulation 2021. It's obviously we are issuing equity shares, sweat equity. For listed company, then these rules will be followed, 17, 11, I'll come to it. And if it is to unlisted company, sweat equity to unlisted company, then you will follow Companies Act, Section 58 or Section 54, Rule 8. So sir, what are you saying? So pay attention to what am I saying, that if you are issuing sweat equity or any kind of employee benefits, okay, you are issuing to a listed companies issuing, then they have to follow with SEBI SEBS regulations, sweat equity and this regulations. And if it is an unlisted company, you will follow Section 54 read with Rule 8. Is this clear? In the exam they ask all these questions. They ask, right, what is the pricing methodology for listed companies, and you will write SEBI regulations. If they say what is for unlisted company, then you will write there. Now I'm just thinking that what is happening is employee benefits are being issued. So obviously they will not be given at market price, they will be given at lower than market price. So what will happen here according to you? What do you think will happen? Obviously a registered valuer will be appointed. He will apply the valuation principles, etc. Let's see. Okay, that employee stock option. So which is the regulation name? SEBI Share-Based Employee Benefits and Sweat Equity Regulation 2011. That the company granting the options to its employees pursuant to ESOS, okay, shall be free to determine the exercise price. So the first line is you are free to determine the exercise price, how much ever discount you want to give, but just conform to the accounting policies. Second, they say that the accounting standard should be followed, okay, and there is a guidance note for employee share-based payments that also has to be adhered. So fine. So first point is you are free to determine exercise price. Second, what they say that the accounting standard should be complied. Okay, fine, the accounting standards will be followed. Third is regulation number 22, that you have to confirm with the accounting policy, then you have to give a minimum 1 year lock-in period. Okay, then if it is a part of public issue, now very logical, if it is a part of public issue and the employees are bought at the same price, then there will be no lock-in period. Common sense that if the employee is buying at the market price, then how you can have a lock-in period? So if this ESPS is given at a public price and the employee is buying at the same price as that of public, then there will not be any lock-in period. Otherwise there will be a 1 year lock-in period. Means what? Minimum 1 year. So company will say that you work for minimum 1 year, then you will get these rights. Okay, then you can convert these ESOPs into your shares. Now what if he dies in between? What if he becomes permanent disabled? Then will the lock-in period apply? So here they are saying that Okay. So first point, they are saying that if the company gets amalgamated, then this should be transferred. The benefit should be transferred, okay, to the other company. So how much ever time period you'll hold in the transferor company, that will be counted in the transferee company also. In event of death or permanent incapacity, the requirement of lock-in period shall not be applicable from the date of the death. So if a person has died during the lock-in period, he can get all the shares as well. Now, coming to your price of equity shares shall be according to the pricing method stipulated under the preferential issue to a person other than qualified QIBs under this. So, how will the minimum pricing be there? The price of sweat equity shall be determined according to the pricing. Sir, where is this given? Here for non-QIB, it is your regulation number. Can anyone tell me? We just did this. We just did this now. That this one, your regulation 164. This is for non-QIB. So these are all non-QIB. So your even in sweat equity, this only will be followed. Okay, simple. Now moving forward to what if it is, sir, sweat equity, but for it is sweat equity, but for this other thing, unlisted company. Very good. So if it is a unlisted company and they are issuing sweat equity, now you think they will have all these main regulations applicable, SEBI regulation? Answer is no. So very simple. What they have said, that a valuer will be appointed. The registered valuer will try to study that particular what kind of intellectual property he is giving, will try to value it. He will give a justification for this valuation, that this property that the employee is giving is worth so and so, and that is why against that so many shares are being issued. A valuation report will be prepared and it can be shared with to the shareholders also. Now accounting treatment. Now pay attention to the accounting treatment for sweat equity. Now sweat equity is what? Pay attention. Okay, what are they saying? That if it is a how it will be shown in the books of account. How it will be shown in the books of account? Very simple. So if a intellectual property, if what is sweat equity? Pay attention. What is sweat equity? Is company is normally when they issue to anyone, employees. Okay, let's say they are issuing shares. So if the company issues shares to the employees, normally the employees would have paid money. Now they are not giving money, they are giving intellectual property rights. So what this is called as sweat equity. What do you mean by sweat equity? Sweat equity is issue of equity shares for non-cash consideration. This non-cash could be technological know-how, any kind of intellectual property, etc. So the shareholder is giving intellectual property, against that company is giving shares. Now the question comes that how will this be shown in the balance sheet, in the accounts? So here they have said that the company has purchased this intellectual property. So they have two options, either to put it in the profit and loss or to put it in the balance sheet. If they put it in the balance sheet, it will be treated as an asset. So software is also an asset now. So if they want, they can put it in the balance sheet asset side as a software, or they can put it in as a expense, that profit and loss. How you buy an antivirus software, not everything goes in the balance sheet. Company must have bought something, so if they have bought it and it's not very valuable, not very thing, then they can show it in the books of account as an expense. So ideally company will always prefer to show it in the asset side, because the assets value will increase. However, if the auditor is saying that this is not that big, valuer is saying it's not that big to go in balance sheet, you can show it as a purchase expense only. So whatever, two methods they have shown. Accounting treatment, where the shares, where the equity shares are issued for non-cash consideration, such non-cash consideration shall be treated as in the books of account as an asset, then it will be put into the balance sheet. If it is not being in the balance sheet, then it will be expensed out and put into the profit and loss account. Simple. Then we go to the next thing. So 164 we have done. Then we did this for listed companies, sweat equity, unlisted also we did. Now they say for delisting. Sir, what is delisting? So when a company gets listed on a stock exchange, they follow with SEBI laws. But when they get delisting, they have to get delisted in accordance with SEBI delisting regulations 2021. Sir, now I have to learn the pricing that for a delisted company, what will be the price? So for them, they have simply said that the floor price, the base minimum price, will be determined as per Regulation 8 of Takeover Code. So Regulation 8 of Takeover Code talks about open offer, how the calculation for open offer. So simple, that when a company is getting delisted and they want to set the floor price will be as per Regulation number 8. So what is floor price, sir? Okay, so let's see. Now pay attention to this. Okay, so what is it that when as per delisting regulation, now delisting regulations, so it is mandatory on the promoter to give exit opportunity to investors. He should give exit opportunity to the investors, because investors would want to sell their shares and run away, because now they will be earlier they were shareholders of a listed company. Now after delisting, they will be shares of unlisted company and very difficult to liquidate. So as per the delisting regulations, promoters mandatorily have to give a exit opportunity. Now the promoters will issue something called as a price band, but this is called as reverse book building. See, normally what happens in book building, it comes at the time of issue of shares. People will bid at what price they will buy. In reverse book building, the shareholders will bid at what price they will sell. Okay, and as per the delisting regulation, they have to buy at least 90% of the shares. So they have to buy at least 90% of the exit opportunity should be given, and they should be ready to buy out 90% of the investors, whoever want to exit. Now what are they saying? That the promoter will have to give a price band. So a floor price will be given, and they will give a upper band. Okay, floor price and the cap price will be given. Now floor price, how will we determine that this much is the minimum you should be ready to buy out? Promoter will say, I'll give you 10 paisa. So they say no. Floor price will be determined as per Regulation number 8 of SEBI Takeover Code. So as per Takeover Code, Regulation number 8 tells how pricing can be found. That you get it, you will keep it here. It is a floor price, and upper band will be there. Within this, people will bid at what price they are ready to sell. To determine in the final that how he has to purchase only 90%. So in the end, it will come out that what is the final price will be determined on the bidding amount. That final price is called as discovered price. The discovered price is after the bidding, etc. You can discover what is the price. So let's move ahead and quickly finish it off. Okay. So what it is, that Regulation number 8. So after fixation of the floor price, the discovered price will be determined through reverse book building. Sir, beautifully explained. Discovered price will be determined through the reverse book building. For floor price, how you will fix the floor price? Go as per Takeover Code and fix the floor price. Okay. Then the indicative price can be given. If the promoter wants, he can indicate a price, that this price I am ready to buy, etc. It can be higher than the floor price. So he can indicate at what, even though the floor price is there, a indicative price can be given. I am ready to buy at this price. Promoters can mention. So that also will be declared. Okay. Higher price than discovered price. So acquirer may pay a higher price than the discovered price if he deems fit. So if the promoter is ready to pay shareholders more, absolutely fine. Okay. Now we come to your SAST regulation. We saw how the price is computed is given in regulation number 8, SEBI takeover code. So that you can read it from the takeover code regulation. Now we talk about consolidated FDI policy. Sir, why it is important? Okay. So okay, very simple. So valuation in case of foreign direct investment. So now pay attention that normally when a foreign company is investing in India, so it is a FDI. So this is the company they are investing, it is a FDI. So maybe they could invest in a listed company or they could invest in a private or unlisted company also. Now the question comes at what price it will be issued. So there is a investor, foreign investor. He is ready to pump in money into the company. Now we have to issue shares at him. So what will be the value of the shares that we issue to them? So they have said that very simple, if okay, only one main rule is there, that they cannot issue at a price to foreigners a price lower than what you give it to a resident investor. So if I give it to Indians at 110, to foreigners you cannot give a bigger discount. You have to sell at higher prices only to, or same prices to the foreigners. That's it. So in case of foreign direct investment, the price of shares to be issued to resident outside India shall not be less than price worked out by SEBI. If SEBI will come in if it's a listed company. If it is unlisted company, then a price worked out by a registered valuer as per internationally recognized practices, or the price available in the past, price which has gone from resident to non-resident as per RBI guidelines, where shares are issued on preferential allotment. So basically they're just saying that if in the past RBI has issued any price, SEBI has issued any price, or registered, highest of these two you will give. Now comes evaluation requirements under different statutes in India. Now what happened is, I told you valuation can be recommended as a law, or it could be as a non-statutory thing also. You want to voluntarily do it. In various act where it is told that valuation is mandatory. So we will see under Companies Act which are the sections which are telling that valuation is mandatory. We will look under the IBC code, insolvency, when valuation is mandatory. We will look under SEBI Act, Income Tax Act, FEMA Act, etc. Various acts where it is told valuation is needed. So basically you can just read through, not important, like when a Companies Act, when your issue of shares, issue of sweat equity, issue of ESOPs, issue of preferential issue, deposits, okay, compromise arrangement to identify whether you're minority shareholder, M&A. Okay, all this is needed. Now, Rule 8 says that the conduct of the valuation in terms, mandatory contents to be stated by the valuer in the valuation report. So, the valuation report should contain what all? Just logically think. First, if I'm a valuer, I will mention the basic details about the company, the purpose why we are doing the valuation. We will also say who is the company for whom we are doing the valuation, what is the methodology that we have used, any kind of assumptions that we have taken. Okay, all those will be given. So it's a very simple contents of a valuation report. Background, purpose of valuation, they will identify who he is, any conflict of interest if any will be told, appointment date, inspection done, major factors, etc. Okay, now comes valuation expression of value. Okay, 2 minutes. Just read through this and till now tell me in the chat box, have you understood everything or not? Just have a water and we'll continue. So now we continue. What valuation expression of value? Okay, Now what it is, they are telling you different kinds of value. Okay, so if I tell you value means, you will say the worth of the company, the purpose. However, value changes. Okay, so maybe for municipal value might be different, fair market value will be different, etc. So let's look at different expressions. They can definitely ask you for 5 marks. Okay, 5 marks, or two things they will tell you to for 5 marks. So first one is fair market value. So fair market value, fair means the correct price. Fair means a reasonable price, a proper negotiated price. You know, we are not talking of any sold in compulsion. Any kind of distress sale is not covered here. Okay, fair means what? A reasonable price that you have got. Now market price, moment I say market means what? You've gone in the market and sold out. So when I say market means, it is between a buyer and a seller, real buyer and seller. So when I go in the market and I sell my mobile, that is the fair market value, which in the market I have got for buying and selling. So the amount for which an asset or liability would be exchanged between a willing buyer and willing seller at arm's length price. Arm's length price means what are the fair price at a reasonable price with unrelated person, and you got a proper amount where both the parties have proper knowledge of what they are doing. They have done it prudently and without any compulsion. They have done their negotiation, etc., and properly they are selling without any compulsion. Very simple. So distress sale will not come here. A person who is doesn't know the value of the goods and just randomly selling will not come here. So fair market value, you have to write buyer and seller. Very similar to fair value. Sir, what is fair value? Fair value means it is a approximate figure that you should fetch in the market. The above one is actually between a buyer and seller, what is there. So for example, my fair value of my mobile phone could be, the fair value of my mobile phone could be 30,000. Okay, so fair value could be 30,000. But when I go in the market, I might not get 30,000. I might get an amount little bit up and down, but it will be close by this only. So again, fair value is a reasonable expectation. Okay, and above one, market value is between the buyer and seller. This is the knockout price. This is the sale price. So this is a orderly sale. Inorderly sale is basically a distress sale that you have done. So it's not a distress sale, it's a fair price that you have received on a asset, okay, which would be received in between market participants. So this is something that you would have received. When you actually go in the market, maybe there must be some up and down. That is the fair market value. Okay, is the exit price when you go to sell. It is between market transactions, market participants, and it is an orderly transaction. Orderly means what? It is not a forced sale or it is not a distress sale. It is an orderly transaction. Simple. Then comes, sir, what is book value? So book value is the balance sheet value. Balance sheet value as on appearing on the balance sheet. So I take all the assets less liabilities. Normally I go to open the balance sheet, look the asset less the outside liabilities, whatever it is the net worth of the company or the book value. It has nothing to look at the market prices. So all the historical figures appearing in the balance sheet is to be taken. So book value is a historical value. Okay, so for example, if land is given, so land might be there, but in real market it might be something else. So we don't care of that. Historical prices will be there. It is the difference between assets less liabilities, as we do net worth. Okay, simple. Then we come intrinsic value. So in intrinsic value, the it's your NPV method. Capital budgeting you have done. So intrinsic value takes into account present value of money. That means any future money that comes in will be discounted to present value. Okay, so in intrinsic value, the real value of the company, qualitative, quantitative. So qualitative could be with respect to the board, their performance, the ethical company. Okay, all those qualitative factors can be looked, the goodwill, image, and quantitative could be the cash flows, all of that. Okay, and does not consider the market value. We just take the expected future cash flows and we discount it to present value, applying a proper discount rate or PV factor. Simple. You can write it and close it. Sir, what is qualitative factors like the company's performance, productive, business management, etc. And quantitative are all financial numbers. So intrinsic value, please write about capital budgeting PV factor method. Now we come to replacement value. Sir, what is replacement value? And just look down below. Here they talk about reproduction value. So I want you to learn two things: replacement value and reproductive value. So replacement means what? For example, if my AC is not working, if your AC is not working, you will want to replace it with a new one. So the price of the new AC is the replacement value. So today I will be thinking that if today I have this machinery, but if I want to knock it off, then what is the real price that I will have to pay in the market? So the price of substitution of by a new machinery, which will do the same nearest equivalent utility. So replacement value is the current cost of acquiring a similar property which is likely to produce the nearest equivalent utility. Okay, so you are just replacing the current machine with the new materials and technology. Done. Sir, then what is reproduction value? Mark as reproduction value is important. Now reproduction value is basically you get the duplicate asset with the same condition. So for example, if I want to see that if I have a 2-year-old phone, if I replace it with exactly a 2-year-old phone, how much will it cost? So that is called as reproduction value or a replica value or a duplicate asset value. So in replacement method, what do? You replace it with a new asset. In reproduction method, you replace it with a duplicate asset in the same condition. So then you will compare that, this is the value. Going concern basis is basically the value of a business is calculated on going concern basis, means the current cash flows are expected to continue in future. A going concern basis will be more valuable than a company which is not going in concern, which is at the time of liquidation you might not get that much value. Okay, so factors like your trained employees, brand generate greater value because all these assets and intangible assets will generate benefit to me. So you would want to buy a going concern company or a company which is going in liquidation. So a going company concern basis is good because the asset keeps generating money in future also, whereas in liquidation, now the asset is just sold and that is much you have got. Okay, so standard 102 says going concern value is the business enterprise that is expected to continue and operate in future also. Okay, now we go. So this is give an example that basically a company which is going in liquidation is only 10 million worth, but if a company would be a going concern, it would be much more worth because obviously assets would be generating more future. Now equity interest value. Now understand what is equity interest value. Very, very simple. It is about this calculation, a very simple calculation, that equity interest value. Okay, what is the value of my equity shares? So just remember ROI. How do you calculate return of interest on shares? So for example, if I had bought shares and it has given me dividend of 10 rupees. Dividend I have got 10 and I have got capital gains. Okay, capital gains of 20 rupees. And I had invested 100 rupees. So this was the investment price. Can anyone tell me what is the return on investment? So obviously you've earned 30 rupees on 100, so that is 30%. So this is nothing but equity interest calculation, your ROI. Sir, what did you do? I took dividend plus the capital gains. Capital gains means the P1 minus P0. So my original price must be 100 and I have sold it for 120. So I have got a capital gain of 20. So let's see what they have given. That's it. You can draw the formula also. That equity interest of an investor shall be considered while doing a investment. So while making an investment, we'll see how much ROI is there. Okay, because it will be assumed that this will continue in future also. The purchase of equity shares as a long-term investment can be different as compared to a short-term investment. Coming back, return on equity investment is equal to the dividend plus the capital gains divided by the market price. Write it in your own words and close it. Insurable value. Now, what does the word insurable value mean? So, insurable value is always of insurable. So, what the insurance company is fixing the value. So, whenever you take an insurance, they will study the particular asset and fix the value, that is called as insurable value. Now, insurable value is always calculated of destructible assets only. So in your company, you can do an insurance of machinery, you can do a insurance of building, you can do an insurance of your goods, but you can never do insurance of land. Okay, insurable value does not include land because land is non-destructible. So only your destructible things you will do and it gets insured. So that is your insurable value. Now in your M&A etc., you would look at whether the business has insured all its assets or no. If not, then you will have to look that, listen, this company is not done, I might have to pay for the insurance is done needed. Okay, now we come to two things, which is value in use and value in exchange. Now this is very similar to what we had done above. Pay attention when I say, and just remember the word asset instead of value. Remember the word asset. If it is in use or it is not in use, it is going to be exchanged for money. Okay, now when I say, when we had done it above, can anyone tell me what was the concept there? So this we had told it was going concern basis, right? So always in use means it is currently in use, it will continue its operation and therefore it is more valuable. Whereas when it is not in going concern means it is going under liquidation and the entire asset will only be sold. So that is called as in exchange, means the asset will be sold and without any role in business, without being able to generate any future income, we are selling this individual item. Okay, so obviously value in exchange might be lower because it is sold piecemeal without any business benefit. Then we come to goodwill value. Now goodwill is very simple. Goodwill is if the anything which you have get over and above the market price is called as goodwill. Okay, goodwill you get on your assets, intangible assets, and for future benefits etc. It is a quality. Let's see what does goodwill mean. When we do M&A, and that time you see that if the consideration paid is 12 crores, but the net asset value is only 10 crores. So why did we give 2 crores more? If the assets are worth 10 crores, but still we are paying 12 crores. So 2 crores will be goodwill, and it is shown also in the accounting treatment as goodwill. Now we come to salvage value. Now salvage value means the scrap value of goods. Now understand that as per Income Tax Act, certain assets have certain set lives. For example, they might say that the computer might only be has a life of 5 years, even though you might use it for more than 5 years. Okay, so that means that the life of the asset might be more, but law sets a certain life, and when you go to sell, you might get something, at least scrap also has value. It will never be zero. The salvage is a sale that you realize at the time of selling the asset, because it can no longer be used for service. Now salvage is not same as zero because you get always some amount. Okay, asset might not be useless to everyone. So knowledge of the salvage value in the target company is significant for acquisition decision. to know that if I am going to sell off these assets, how much I will get. Liquidation value is when goods are sold on piecemeal, not on going concern basis. Okay, now liquidation is carried out in two ways. Maybe it is an orderly transaction or it is a forced transaction. So orderly transaction would be when you have a good enough time and you get a good fair price. It is an orderly transaction. But if your lender is not, creditor is not ready in a short time, you want to sell, then you might have to liquidate at a as a forced transaction, distress sale. Now when we look at this table, it's super simple. Pay attention. It's a super simple transaction. Can you tell me that all these types of values that we have done, which is the lowest form? Lowest form. So the let's say this is 0. Can I say scrap value will come here? Scrap value is lowest point. Explain what is scrap value at the time of sale. Just above that would be a forced liquidation, wherein forced transaction, a forced or a distress sale, you're getting some amount. That is a forced or liquidation. Third one could be a orderly liquidation. So you are liquidating, you're doing a peaceful sale, piecemeal sale, but properly you're doing it with time, selling and getting a good price. Now fourth will be value in use. So if you have, just remember, instead of value, asset in use. So asset is in use, it's going on a going concern basis. Obviously you will get more consideration here. Then comes all your tangible assets. All your combined tangible assets are worth 10 crores, but if you are getting 12 crores, then this is due to goodwill. Just to explain goodwill, they've given you net tangible assets are here, but you are getting 12 crores. 2 crores is goodwill. And when you add up, okay, the total value of your business on paper could be much more. So these are all your limits, it ends here. Clear? Then price and value differentiation. Tell me one thing, is the price and value same? Is the price of goods and value same? Think and tell me. Answer is no. Price is what you pay, value is what you bought. Okay, value is a real worth of a product. For example, if you go for a water bottle, you just go to take a glass of water. So water might be for 20 rupees. So water half liter will be for 20 rupees. But let's say you are in a desert and there is no other shop around you, and one person has come and same half liter of bottle, he is saying I will charge 500 rupees. You might pay for it because the value might be 20 rupees only, but the market prices are dependent on demand and supply. They are always dependent on demand and supply. So sometimes even goods which is valued at 20 might go at 10 rupees, or it might go at 500 rupees because of demand supply aspects. Okay. Now imagine another thing, that if you have a pen might cost you 20 rupees. But let's say you have forgotten to take your pen in your exam hall and someone outside is selling the pen. He will sell for 50 also, you will take. 500 also you will take. Okay. So price and value is normally taken interchangeably, but they are not. Price is dependent on demand and supply, and whereas value is about the real worth of the company. Okay. Then process of valuation, purpose, etc. methodologies are given. Now we'll see the methods of valuation. Again, this thing will be repeated later in the next chapter, but just remember your market approach. Market approach could be called as your net asset approach. Net asset approach. What do you do? Let's see what they've given you. Yeah. Okay. So 3 methods of valuation. Let's do it here. In market approach, what are they saying? That you look at certain market prices. Market approach is a valuation approach which uses prices generated by market. So it uses prices generated by market forces, etc. I'll explain to you with example, but let's see what all points they have given. Okay, in market approach, valuer has reliable information about the comparable assets. So we have information about comparable or identical assets, and it is a orderly transaction. Very simple. Let's take a particular, let's take in real estate. Okay, let's say you own, what can you tell me in the WhatsApp, your house, your flat is how many square feet? Let's say if your house is 700 square feet, okay, and in your building this same flat, okay, on the same floor has gone for around 2 crore rupees. So what is happening is, this is a past transaction, this is a past transaction of a comparable asset, So accordingly, I will come to know that your house will also be around 2 crore rupees if it is the same square feet, same building, same view. So this is what they are saying, okay? And they tell you also that this is mostly used in real estate, etc. Or if a company has been bought over, similar size in the similar industry. So let's say if we have Coke, which has a valuation of 20 crores. So similarly, we know Pepsi is also around 20 crores if they have all the same matrix. So valuers shall not be, this method should not be used when there are no comparable assets, nothing is traded properly, we don't have sufficient information, there are no recent transactions, and there are material differences between the two assets, then we will not use it. Then we come to the NPV method. Sir, NPV method is same as income approach. All your future cash flows and inflows will be brought to present value, and then the value of the company is found, and then you would invest. So for example, if I want to see that this company is there, it is generating so much income, so this will be income in future, I will all bring it down to present value and then see how much money I should remove today. Cost approach. Okay, now in cost approach, remember, we are seeing the cost of substitute. Two methods I have taught you, you can write it here and close. Replacement cost and production cost. Okay, so I told you here also same thing they do. Replacement cost, same utility. Okay, like no person will pay more than the cost of a substitute. The buyer will not pay more for an asset than the cost to obtain an asset of equal utility. For example, if I'm going to buy something which is very same and it is rupees 10. So you will not pay anything more if I'm getting an exact direct substitute for another price. Okay. And you can mention about what is replacement method when new asset is there, and reproduction method where the replica of the same condition is brought in. Now principles of valuation, this will come in the end. Okay, we will see. Do the headings. Yeah. Principles of valuation will come in the end. We'll do that. Hindrances or bottlenecks in valuation. So if I'm doing a valuation, what all are the problems, obstacles, etc. Now valuation is completely vague. Okay, it's a vague concept. It will have different valuers, will have different concepts. Second, different opinions. Uncertainty in valuation. Now obviously value keeps fluctuating. So even if I fix now, market forces keep fluctuating and competition keeps coming. So the valuation keeps changing a lot. Then inherent subjectivity. Now may be considered as a science, but it requires subjectivity, a perfect knowledge of the value. So no market force will know the exact value of a price. Each value is context specific. Means you can write a context specific means what? That maybe in this situation someone is ready to pay this much, someone else will value the same company in a different situation differently. Everything is, all the assumptions are hypothetical. Okay, cost and value, very difficult to do, and it can be very well exploited by man. Okay, assumptions, market comparables are not easy to find. Valuation standards might not be used, very critical to use the valuation standards, etc. Okay, now remember I told you that these principles will come in the end. So these principles you can write. very important is general, that headings you can do, that core valuation principle. So if I'm a valuer, I have to ensure that everything is done with market integrity. I should be competent, I should comply. Okay, the basis of valuation, the reason for doing the value should be there. Effective date and valuation date should be given. All the assumptions, headings you can do, scope of work, all these things shall be informed. Okay, with this we have completed the entire chapter. Thank you. Hi, so we will be starting with a lesson called as valuation of business and assets for corporate restructuring. Here when we say valuation of business and assets, here they will be talking about the various methods of valuation. Before we start business valuation, what do you mean by the term valuation? Now earlier we had seen the simple meaning of valuation is to identify the worth of an asset. Here when I talk about business valuation, it is basically valuation of an asset. Here is a business. So you try to determine the economic worth of a business looking at its past and future aspects. Okay. Now during valuation, company not only looks at the past performance, but they also look at the future earnings of the company. Okay, and as you go out to shop, you would want to make a good intelligent decision. If you make a proper valuation of the asset, you will get to pay a good price and make a benefit. Now in business, when we saw corporate restructuring is nothing but M&A, mergers, amalgamation, takeovers, etc. During all this process, it is mandatory under law, okay, in multiple section, where it is said that you have to do a valuation. Okay, so sir, in M&A, merger and amalgamation, where valuation is done? So let me tell you that whenever you do a valuation, you have to fix a swap ratio. Obviously a swap ratio, right? So let's say if company A is merging with company B, company A is merging with company B, and they are becoming company AB. They are becoming company AB. So obviously we would want to know that the shareholders of A, how many shares they will get of AB, shareholders of B, how many shares they will get of company, the new company. So for how many shares of old company against the old company shares, how many shares they will get in the new company. So only when I determine the value of both the companies, the swap ratio can be determined. Okay, now tools and methods of valuation. Obviously we will see multiple methods of valuation in this chapter, and the main objective of any valuation model, of any valuation method, is to determine the true value of the company. Okay, now very important is just a concept called as financial modeling. Valuation involves financial modeling. Sir, what do you mean by the term financial modeling? So what happens is, tell me, I'm asking you a question, whether financial statements of the company and valuation is same. Is financial statements of the company and valuation same of the company? Answer is no. Obviously, in order to find the real value, you look not only at the past aspects, but you also look at future prospects. Okay, that is called as financial modeling. Financial modeling is taking into account both past activities as well as future income. Okay, so and obviously applying multiple methods to valuation, which one to use, etc. will be done. One important thing is financial your valuation is a subjective concept. It differs from person to person. Each person might use his own method, must do his own procedures, etc. Now, what are the motives for valuation? Why would you want to do valuation? So they have bottled it down into three categories. One is financial, business, and behavioral. So three categories of motives to do a valuation. The first one is to determine the financial worth, whether it is worth financially to enter into the transaction. Second, whether I try to quantify the benefit. Maybe I'm trying to quantify the section 72A, which is about taxation benefit, or whether I'm planning to do asset stripping. Asset stripping means what? I sell the assets for profits or gain. So I plan to take the asset for 10 and sell it at 15. So this is whether that is the objective, where it is purely monetary reasons. The other reasons could be business expansion or business diversification. Okay, that is a business related reason. So why am I doing a valuation of the business? Maybe the purpose for me, the motive here for doing a M&A is entering into expanding my business into a new territory. Or I could see that, listen, I would want that, listen, my company has X weakness and that company's strength is that. So I don't know, I don't mind paying more. I need that strength, so I need to take over the company. And behavioral could be personal ambitions, personal grudges, that I want to take over your company for whatever reason. You had harassed my father, so I will take over. So these are random, any ambition that could be there. Okay, now need for valuation of a business. Okay, now what does it mean? So first thing is, why would you want to do a valuation? Now, as we saw in the earlier chapter also, everything, if a merger or amalgamation is going on, or if some company is investing, some investor is investing, he will do a valuation of the company and then make his investment decision. The next thing is financial reporting. Okay, so sometimes it is required to value certain shares, etc., as per law. Estate planning, if brothers want to divide, they will say 50% of the assets you keep, this much I'll keep, so that is done. Shareholders dispute to determine operation mismanagement, section 241 to 246. Okay, any litigation goes on and they are telling to do a valuation, or any strategic business reasons. Now situations requiring valuation, similar things they have said, all is covered. Okay, investor, if we are making public shares, JV, open offer, you want to purchase some shares of section your 241 to 246, conversion of your debt into equity, so again you need to do valuation. Okay, required under law. Now factors influencing valuation, so this also earlier we had done, and in the exam they had asked you what are the factors influencing valuation. Now you have to say that valuation is a complicated process. Okay, and the value of the company is determined on past as well as future earnings. Now obviously, to determine whether the future earnings are reasonable, calculations are done properly, you require a registered valuer. Now a registered valuer will look at multiple things, and multiple things can affect the valuation. For example, if your company is extremely into debt, or if a company has a good PE, or if your company, we look at your market price, what all things they will look. So the debt equity ratio, the growth, the customer base, the area of operations, financial statements, litigation if any. Okay, I will also look at the voting aspects, whether it's a good dividend paying company. I'll look at the growth rate, I'll look at the voting rights, past history of share price. I'll look if the promoters have taken a lot of those shares, special differential voting rights, then I would not want to value it well. So all those factors you will look. Now preliminary steps in valuation, very simple. So this general stuff they are telling, that what is the initial things that you will do. Okay, so business valuation involves analytical and logical analysis of not only the past but also the future attributes of the company. So very good English they've used, that a valuation involves analytical and I want you to write this in your exam. Okay, so a business valuation involves analytical and logical analysis of past and future prospects or attributes of the company. The preliminary study of valuation as of the following aspects. So again, further they have told you, so all these 3 points you can add up. Reason of valuation, whether it is listed, unlisted, the PE, the competitors, the technology, the discounting rate, all these factors will be seen. Now this chapter we will mainly be seeing the methods of valuation. So initially they will give you some method and they will repeat it again in the chapter. So just I'll go faster here because in depth it will come later. Just remember your market approach. Market approach means you will look at the value of similar size companies. So if a company has similar customer base, similar revenue, similar every aspect, okay, let's say there are two identical companies and one company and the same competitor which was of the same kind has been valued at 2 crores. So we will say that on basis on market data, even your value is 2 crores. So you determine the value based on market data or any past transaction. Income approach, I want you to write it down. Income approach is use the DCF or the intrinsic value method. Net asset asset approach means you do the net asset. Assets less liability is your net assets. Multiple based approach. Now multiple based approach is something new. Let me tell you what it is. Okay, so market is important. Multiple based approach, once and for all I'll explain. For example, okay, let's take this example that okay, now if I'm looking at the PE ratio, earnings or sales, okay, so I'm looking at PE ratio. Have you heard of the term PE? PE ratio, PE ratio, or let's keep this only, okay. Now understand, I'm looking at certain multiples that this is the company that I plan to value and this is the industry average or competitor, industry competitor. Now imagine if the industry's competitor price to sales ratio is 10 times. Okay, that means when the sale is 1 crore, okay, the value of this company becomes 10 crores. So if the competitor or the industry average is saying that you have that the industry gives a 10 times multiple to the of the sales as the value of the company, means whatever is the sales, if sales is X, value of company will be 10x. So similarly, if I find that this sales of my company is XYZ is 1 lakh, so according to applying the market comparable method, that they will say that a market multiple is 10 times whatever is your sales. So just let me simplify. As per market comparable, you will look at an industry average, a industry practice. So if the industry is practicing that the value of company is 10 times of sales, right? So then if I want to value company X and I find that their sales is 1 crore, so automatically I know as per applying the market multiple is which is 10 times, your value of your company becomes 10 times that is of your sale, that is 10 crores here. Simple. Okay, so what did we do? We did applied a multiple to the to determine the value. So in this method, a financial ratio or multiple derived from certain comparables and industry averages is used. Okay, the choice of this method depends on various factors. Why did you do it, which industry you're picking up, data you're getting, and similar circumstances. Okay, remember this is not an exact valuation that you ever get. It is not an exact science, but it is based on a approximate science that approximately this should be the value. No person can say this is the exact value of the company. Okay, so professional experts are there. They, after in-depth research, they give the value of the company. Now same thing they will repeat. Now valuation we have done. Now they've just said for merger. Now valuation principles and techniques we've done. We did valuation techniques and methods. Now for merger, now same thing, same headings, they are going to repeat it again. Comparable market analysis. I told you that you use a techniques involved using a comparable company in the same industry and using a price to sales. I gave you the same example, or price to earning, and basing on that you determine the value of the company. Then the income approach. This was the income approach. Sir, what was income approach? Where the discounted cash flow method is used. Then synergy analysis, just to identify how much gain the combined entity will get. Okay, so how to define synergy? Where the aggregate value, so just write it. Normally people understand synergy and they always give this lame little example of 2 plus 2 is equal to 5. But that is not the definition of synergy, right? No doubt it is right. 2 plus 2 is 5. 1 is the synergy amount. But to explain it in words, English, how do you explain? Where the aggregate value of companies, aggregate value of company is greater than the individual, or we could say this line, that the combined value of companies is greater than the aggregate of individual companies. So when I add up two companies, it's coming to 2 plus 2 is 4, but the combined entity is coming to be 5. This is called as a synergy. This synergy, why you are getting this extra? So this extra is coming, maybe you are getting a economies of scale. Okay, economies of scale, or maybe now the brand value has changed, or market has expanded, or cost has been reduced due to the synergy benefits. Net asset value is nothing but assets less liabilities. Done. Market capitalization. Now this is simple. Market capitalization is market cap. How is market cap calculated? Do you know that? Simple. Market cap. How is market cap in companies used? So you use your market price into the number of shares. Market price into number of shares. So for example, if the market price of the company is 100 and there are 1 million shares, so the value of this company becomes 100 million. What is it? It's a straightforward calculation where you do market price times the number of shares. So they've given market price multiplied by the outstanding shares is the value of the full company. Okay. So one share is worth 100. So 1000 shares will be worth how much? Transaction multiple, same they have repeated as before. Now, same thing they will repeat. Okay. So they keep repeating the same thing again and again till it gets into your head. So asset base, assets less liability, income is, I told you, is your DCF method, discounted cash flow method, and market based approach is you use a multiple method. A multiple, as I told you, P is 10 times, PS, that to determine the value. Now asset based approach, what do you do? Now pay attention, okay? So you do your assets less liabilities is equal to your net assets, right? Now the thing I want to know from you is the price or the assets that you will do is as per market price, or it is as per historical price, book value price. So when I'm doing this method, where am I going to use the market price of the assets, or I will use the book value price of the method? The answer is you can use both. So any can be used. So normally market price will give you a more accurate view. Now because the real time building I'm taking real time. So if you do asset based approach as per the prices as on market price, it will be much better than using the balance sheet method. Okay. So asset based approach is assessing the value on basis of the net assets. Sir, how to calculate the net assets? Assets less liabilities. Arrive at the net asset. They've given a very simple baby example. Okay, what they have done is, if you see this example, net assets is equal to total assets minus the total liabilities. So they have written down the total assets here and the total liabilities has been given. So when you take simple little calculation, if we do, what is it? 16 minus 6.5. So 9.5, right? So let's see. Is your 9.5. Baby example, nothing, just subtraction they did and closed it. Okay. Same example here also. What did they do? They took the total assets and they subtracted with the total liabilities. So again, if I go, it is 12.5 minus 5. So 7.5. So you come here, it is 7.5 is a net asset. So simple minus they have done directly. Okay. So just to show how easy it is. Flows are brought to discounted through a discounting factor, PV factor. Market capitalization method, same thing. When I tell you, they use the market capitalization method, that is the market price. So you can use methods for income based. Main is a discounted cash flow method. Rest all you can write. They just told you here, the ratio method, the multiple method. Okay, they've given you. Now, market based approach. Now, what is a market based approach? Pay attention that the similar, so basically you take a past transaction, okay, you get it through market data. So for example, a similar sized company has been sold in the market for 2 crores. Has been sold with a value of 2 crores, so your value is also 2 crores. What did we do? We looked at a similar size business which changed hands, and that becomes your value of that company. Okay, even you might not get exact same businesses, but even similar size businesses enough. Okay, so here they are telling, like I give you the example of real estate. Your house is of how much, whatever is your value, all your flats in that building of having the same carpet size should be among the same pricing only. Types of market method is transaction method. If you look at a particular transaction which has gone, or if it is publicly known, then you look at that figure. Real estate example I gave you. Okay, recent M&A. Now backsolve method. Now imagine what is a backsolve method. If you see Shark Tanks, what do they say in the Shark Tank? That the previous round that I have done at a valuation of 2 crores. So this becomes the benchmark. So a backsolve method is a recent equity transaction with an unrelated investor, which gives me the value of the company. So you say that the last round was done at this much, so we know that your value is at least 2 crores. Okay, now again, discounted cash flow method, it was called as your income approach, income method, same thing. Okay, how to do it? Where if you see the simple calculation on how to do discounted cash flow method, okay, sums are done separately. You can either join the dream batch and get the sums, where or Samina ma'am will be taking the sums. Right now I'm not taking the sums at all, I'm completing everything else. So let's say we are doing the DCF method. Now pay attention, how do you calculate the form? What is the format? The discounted cash flow method, also called as NPV method. In executed we are done. So you write the year 1, 2, 3, 4. Then you write the inflows. How much inflows are we getting? So in this year, how much you're getting, etc. 1 lakh, let's say I'm getting in every single year. Okay. Then you put the PV factor. PV factor, discounting factor is 10%. Then each of these figures will be discounted at 10%. And let's say when in the end you sell the asset, you sale of asset is there. So when you sell the asset also, you must be getting some salvage. So that will also be an inflow. So you will discount that also. You will find your PV inflow. So all you'll get the 0.91 etc. Multiply this, add it up here. You'll get a PV inflow less your present value of outflow is equal to your net present value. Okay, or just remember that this is the present value of the company. Okay, so all this will be multiplied. Okay, and then you will add it up all of your, you will get PV value of inflows. Now see what all we did. We wrote down all the inflows, we wrote down the discounted factor, we wrote the salvage value, and that's it, done. See this, that what all did we do? In income method we wrote down the future cash flows, future inflows, how much we are getting. We wrote down the discounting factor, PV factor. We wrote down the inflows, the terminal value, the salvage we wrote. We found the present value. Sensitivity analysis can be done. Sensitivity analysis means maybe in a good time we get XYZ, we factor in all the probabilities also, assumption that maybe in a good situation, normal situation, bad situation, what all will have. Okay, so those also factors will be kept in mind. Okay. Now we see valuation under SEBI SAST. I think we know regulation number 8. The method is there, okay, of calculating the offer price. Offer price. Even in delisting, they say you have to follow regulation number 8 only. Okay. Then we come to slum sale. Mark some slum sale as very important. Very important. Okay. In your definite question of slum sale will be there. In your part A also slum sale has been covered in depth. Here it is only small. So remember what is the definition? Section 2 subsection 42C of the Income Tax Act defines slum sale. So in slum sale what happens? The company is sold on a lump sum price without assets being given individual value, without assigning individual values. So if an entire business is bought, so you did not give value to individual assets, right? So selling the business on a lump sum basis is called as slum sale. So that is done. The taxation will be as per section 50B. Okay, 50B is about capital gains. So capital gains will be calculated depending on whether the assets were held for long term, then it will be LTCG. If it is short term, then STCG will be there. In slum sale, what all is there? Assets are sold as a whole for a lump sum consideration. Prices are not assigned individually. Okay, and section 50B is there. And now capital gains tax will be applicable. GST is not applicable. So GST is not applicable to slum sales. Okay. Then came demerger. Now demerger is also given in your tax chapter 1 only, where you have to remember the definition is given under section 2 subsection 19AA of Income Tax Act. It says that when a company is being demerged, it is tax neutral. What does tax neutral mean? That it is no capital gains tax will be levied. Sir, what does it mean? Demerger. So demerger, first the meaning means a separation or a division. So means a division of a business unit from the company is called as a demerger. Let's take a classic example. Okay. So when we let's take a example. Let's say this is Reliance Industries. Now what happens is Reliance Industries had Geo in its segment. They demerged Geo and they made a new company called as Geo Financials. So Geo was first a subsidiary of Reliance that got demerged. This got demerged. Okay. So now what happens is a shareholder here. He was first holding shares in Reliance. Now he will be holding shares in Reliance and Geo. Okay, because he's got split. Let's say the valuation of this company is 100 crores. So, and each division was equal. So Reliance value would be 33.33. So this value, this Geo Financial, you will be having 33.33 and this will be 66.67. So what happened is if a person's company got split, so the new company will also allot me, and this company which is now demerged will have lesser valuation. Combined you will have the same value only. So obviously it is tax neutral. No capital gains will be arise because you didn't sell it to third party. It is just that you had all the money in one pocket. Now you have 50% in one pocket, 50% in another pocket. So your value remains the same. So it is not a gain for the purpose of tax. Okay. Then they said principles and techniques of reporting. Now, principles and techniques. First thing is, as a business valuer, it is your job to make a valuation report. Now, there's a company secretary will make a secretarial audit report. Similarly, if a valuer is there, he'll come and value and he'll give a report. This report will come is an exercise he will do after observation, inspection, analysis and calculation. So he will look, observe the assets, analyze, do some calculations, etc. and then apply certain assumptions of future value. This is called as basis of value. Sir, what is basis of value? Basis of value is basically certain assumptions why he has taken, he will give that. So that all will be done. He'll preserve in the valuation report what all information will be given about the purpose, why he has done, conflict of interest, which method he has used, any kind of assumptions taken, etc. Okay, all these information will be put in. Then relevant valuation and swap ratio. Now obviously swap ratio is normally, let's say if I have company A is there and it is merging with company B, and now we have company AB. So all the shareholders of A will now get shares of AB. All the shareholders of B will now get shares of AB. But how much shares will be going will be determined on the value of the company, that this company this much value, this company this much value, this company this much value. So the swap ratio will be determined looking at the valuation of the company, whether it is 1:1 or it is 1:2. So how much it is there will be determined by the chartered accountant. All the calculations etc. will be shown separately. Okay, in your sums you can do it, don't do it from your sums. We have covered everything. Okay, so with this we have completed the entire chapter as well. Thank you.